Hello everyone, I hope that you came to class prepared today. Today we are going to review the double entry system of accounting. Now I felt that this revision was necessary because the double entry system is a concept that some of you still have difficulties comprehending at your level. And if you are to be successful in executing the other stages of the accounting cycle, then you need to cement the double entry concept in your minds. So today we're going to review the double entry system of accounting. Before we can delve into the meat of the matter, we first need to review the accounting cycle. So my first question to you is, what's the accounting cycle? As you should recall, the accounting cycle is a series of steps repeated in each financial period to record and verify transactions leading up to the preparation of the financial statements. It's important to cement the double entry system of accounting because we know what a cycle is. One thing affects the other. Any errors made in this stage where the double entry system comes into play will carry on through the cycle towards the end. So in order to reduce the risk of errors and to successfully execute the following stages, you need to understand the double entry system of accounting. The dual aspect concept is the basis of the double entry system of accounting, and it states that for every transaction has two aspects, meaning that every transaction will affect two accounts, or it will affect the two sections of the balance sheet at the same time, simultaneously. For every debit entry, there must be a corresponding credit entry. So the transaction will affect one account on the debit side and another account on the credit side. Whatever you do on one side, you have to do on the other. That's what corresponding means. If you put $400 on the debit side, there should be $400 somewhere in an account on the credit side. So for every debit entry, there must be a corresponding credit entry. Of course, sometimes we have compound entries where more than two accounts are being affected. For instance, if you purchase an asset on partial credit, for instance, bought office furniture on partial credit from Courts Limited, $15,000, paying $5,000 by check, three accounts are being affected here. The office furniture account, the bank account, and your liability account, Courts Limited. So even with compound entries, the double entry concept should still apply because the total of the debit side, $15,000, has to be equal to the total of the credit side, $15,000. So whether two accounts are being affected or whether we have instances with compound entries, the double entry concept should come to play. If it doesn't, then most likely you have made an error. Okay. And by staying true to the double entry system of accounting, we can stick to the accounting equation, assets equals liabilities plus capital. That is how we know that we have stuck to the basic accounting equation that will haunt you throughout your accounting career. So understanding double entry is very important. To help you understand double entry accounting, there are a few golden rules, as I like to call them, that will aid you. The first one, assets are debit entries, whereas liabilities and capitals are credit entries, meaning asset accounts usually have debit balances. We will look at that in the end. And liability and capital accounts usually have credit balances. For instance, Courts Ltd is a liability account because liabilities are your debts. It's who you owe. So we are owing Courts Limited $10,000. It's on the credit side because liabilities are usually credited unless we pay them off and close the account. Assets are debit entries. If we were to balance this account, we would have a debit balance brought down, which I'll explain further, of $15,000. So we just have to stick true to the golden rules. You have to find loopholes. You have to find ways to help yourself. Number 2, expenses are debit entries, whereas revenues are credit entries. Now, another common error that you all make is confusing what's an expense, what's a revenue. Revenues sell themselves. They scream at you because revenues usually have the word revenue, received, or income behind them. So for instance, if you see commission received, rent income, interest revenue, it has the word revenue, received, or income behind it. So it will scream at you and tell you, hey, I'm a revenue. But if it has no word behind it, if it's just rent, then the assumption is made that it's an expense account. So revenue accounts will find some way to indicate to you that it's a revenue account. So please try not to confuse them. It's not that difficult in understanding the difference. Golden rule number 3, purchases and sales returns are debit entries, whereas sales and purchases returns are credit entries. I want you to take a moment and think about this, given your prior knowledge as to what these 4 terms mean. Purchases, sales returns, sales and purchases returns. Take a moment and process it, sink it in. All right, so you should have told yourself purchases are always debited because you know I'm always receiving. When you buy something, you are always increasing the value of it in your possession. When you sell something, it's always leaving your possession. You are always giving it away. You are always giving the benefit to somebody else. Whereas when you return goods to your suppliers, for you, it would be purchases returns because something that you previously purchased, you are now going to give it away. Hence why it's a credit entry. But when your suppliers record it in their books, it will be sales returns because for them, it was something that they previously sold, now being returned back into their business. The most simplest way that we try to get you all to understand double entry accounting is by telling you to follow the simple rule of debiting the receiver and crediting the giver. You debit the account that is receiving the benefits and you credit the account that is giving the benefit. It's as simple as that. It will not change. You may have some difficulties when it comes to adjustments and closing entries, when they say to debit the P&L or to debit the trading account, but it's as simple as that. You debit the account that is receiving and you credit the account that is giving. For instance, following our same example, you are buying office furniture. That means you are acquiring office furniture. The office furniture account is receiving the benefit. It is increasing in value. So we debit the office furniture account. Who is it receiving the benefit from? It's receiving $5,000 of the benefit from the bank account. So we credit the bank account, and it's receiving the other $10,000 benefit from Courts Limited. So we debited the account that was receiving the benefits, and we credited the accounts, in this case, that were giving the benefit. But we still stuck true to double entry because the total of our debit side, $15,000, is equivalent to the total of our credit side, $15,000. Example number 2. J. Charles bought a motor van for $15,000 by check. I'm not too sure why I stuck to the $15,000. I must like that number. So we're going to debit the motor van account because the motor van account is receiving the benefit. It is increasing in value. You just bought motor van, so right now it's in your possession. You need to record that it's in your possession. And we said we debit the receiver. So we debit the motor van account, $15,000. This should be here, guys, $15,000. And we credit It's all jumbled up, but y'all get the idea. We credit the bank account who is giving the benefit because it said by check, meaning we wrote a check, we are losing $15,000 from our possession. We are giving away, not literally, $15,000 towards acquiring that asset. So we debit the motor van account because it's receiving the benefit, and we credit the bank account because it's giving the benefit. So for every debit entry, there is a corresponding credit entry. We have 15,000 on the debit side, 15,000 on the credit side. Two-sided effect, same amount, double entry has been followed. Do you understand that? I mean, you should, because this is just revision. So you should have understood it by now, at least. Any questions before I move on? Going once, going twice. Okay, I'll go over it just for clarity's sake. In double entry, the basic way we can help you to understand which account to debit and which account to credit is by telling you to debit the receiver and credit the giver. Sometimes the transactions won't be so literal, it won't be so in your face. You have to apply a little interpretation skills. You debit the account that is receiving the benefit, and in this example here, the office furniture account is receiving the benefit because it's increasing in value. You are buying office furniture, you are acquiring office furniture. It's increasing in value. You own it now, it's yours. So you have to show that. So you debit the office furniture account because it's the one receiving the benefit, and you credit the two other accounts in this example that are giving the benefit. So you debit the receiver and you credit the giver. In my second example, we are going to debit the motor van account because it's increasing in value, and we're going to credit the bank account because it's decreasing in value. We're going to debit the receiver and credit the giver. Now, a common error that is made is to interpret J. Charles as an account being affected. No. J. Charles buying a motor van for $15,000 by check, it's telling us that this is his accounting record. We are in J. Charles's books of accounts. So it's not necessary to open an account for him. It's in his records. We have to show how the transaction affected his records. The transaction being buying a motor van for $15,000. So this mistake, guys, by J. Charles, no, that's not right. Another error that you make is confusing how the accounts are being affected. Again, guys, I'm in PowerPoint technology, so please bear with me. Assets and expenses, being that they are debit entries according to our golden rules, to increase them, we debit. To decrease them, we do the opposite, we credit. Liabilities, capital, and revenue accounts, being that they are credit entries according to our golden rules, to increase them, we credit, and to decrease them, we do the opposite, we debit. Of course, finding loopholes, I'm back to finding loopholes. Most of you may remember deal and clip. You debit your drawings or your dividends, your expenses, your assets, and your losses, whereas with clip, you credit your capital, liabilities, income, and your profit, which you cannot see, but it's there, profits. So deal and clip, a lot of you probably know that by now. Deal and clip, easiest way to remember what to debit and what to credit. So the onus is really on you to determine whether the account is an asset account, a liability account, an income account, losses, profits. The onus is really on you. The last thing I want to look at today is balancing off the accounts, something that you all still cannot grasp at this level. Some of you, that is. When you balance the account, think of a scale. One side is heavier than the other. You want to make them equal. You want to make both sides equal to the bigger number. So you're not subtracting anything, you're going to add the difference to make it equal. Simplest way that you can master it is just remembering the fact that if the debit side is greater, it's going to have a debit balance brought down. If the credit side is greater, it's going to have a credit balance brought down. And I'm saying brought down because we have balance carried down and brought down, as you know. You know that, right? Of course you do. So balance carried down is equal to balance brought down. So it doesn't really matter because the figures are the same. The only difference is the dates. Balance carried down is recorded on the last day of the month, meaning I'm going to carry down this balance into the next month. And balance brought down, I am bringing down the balance from the previous month. But it's equivalent. So if your debit side is greater, you will have a debit balance brought down. And if your credit side is greater, you will have a credit balance brought down. Of course, it's kind of a scrambled here, but based on what I'm saying, you should have gotten it by now. Plus, this is revision, so you know the work from prior knowledge. That's all the time we have for today. I just wanted to review the double entry system of accounting with you because moving on, like we said in the accounting cycle, you have to master this stage in order to master this stage. You have to master this stage in order to master this. And double entry comes in all the following stages. So in order to reduce the amount of errors that you make, you need to master double entry. So for your homework, I want you to turn to your textbooks, chapters 5, I believe, and try a few exercises on your own.